now when I'm filing my taxes, can you tell me all the things which have changed?
If you are staying in these 8 metro cities, the math can change how you claim your income tax. Mumbai, Kolkata, Delhi and Chennai. Bangalore, Pune, Ahmedabad and Hyderabad.
What is that number below which salaried people have to pay nothing to the government?
After Income Tax Act 2025, you will not pay tax up to 15,75,000. Just 3 things, Sharan. Your standard deduction you anyway get. You contribute 12% to Provident Fund. And this is the killer, which is 1,05,600 food coupon allowance.
Swiggy, Zomato, even Blinkit's up to everything.
Right.
Can you tell me how I should invest my money and pay the least amount of taxes?
If you are investing in an arbitrage fund, you have invested 10 lakh rupees into that. After a year, you have a 10,70,000 rupees. Okay. Because you are redeeming after 1 year, would be considered as a long-term capital gain as per equity. And because of that, you will not pay any tax. Because up to 1,25,000, there is zero tax.
Nirmala ma'am is smart, very smart. A lot of people are seeing red in their portfolio. In fact, the Indian markets have gone nowhere in the last 2 years. Is there a way to save taxes?
There is, Sharan. Because
hey guys, welcome back to another episode of the 1% Club show. On today's episode, we're going to be discussing everything about your taxes. This is once again that time of the year when you have to decide exactly how much percentage of your hard-earned money you have to give to the government. Now, obviously, we want to minimize that. So the guest for today's episode is Mr. CA Nitesh Buddhadev. Nitesh is someone who has more than 10 years of experience in tax planning. He currently manages more than 200 crores, and it's his absolute interest in helping you save thousands and lakhs of rupees in taxes over the next 1 hour of this conversation. So make sure to watch till the end, because every minute that you watch in this episode is money kept in your bank account and not in the government. So on that note, let's begin. CA Nitesh, welcome back to the 1% Club show.
thank you so much, Sharan. Always a pleasure.
It's that time of the year again where you are the celebrity for the country. So let us begin, Nitesh. My first question is, up to what amount of income do I have to pay zero taxes? Now, this is different for different people. So let's start with the first category of people, salaried people. What is that number below which I have to pay nothing to the government?
So thanks, Sharan. Thanks once again for having me. So now, when it comes to salary, up till now, as per Income Tax Act 1961, as we are meeting now, Sharan, lot has changed. We are right now in Income Tax Act 2025. That is applicable from 1st April 26. Many people are aware that if you are a salaried, you don't pay tax up to 12,75,000. But if you plan well, after Income Tax Act 2025, you will not pay tax up to 15,75,000.
15,75,000.
15,75,000.
Zero tax.
Zero tax on your salary.
How?
Now, though there is no change in slab, Sharan, but I'll give you an example and then I'll explain that why and how it is possible.
Okay.
Let's say someone's gross salary is 15,75,000. EPF is, I think, all the companies provides. He'll contribute 12% in the EPF. That would be 94,500. So that would be considered as deduction. This is employer's contribution, Sharan, and many people are not aware that under the new regime also, whatever your employer contributes will not form part of your taxable salary. And that's why 94,500, which is 12% of your salary, would not form part of your taxes.
12% of 15,75,000 is more than 90,000.
No, but this will only on 12% of basic. So,
Okay.
assuming that किसी का salary अगर 15 lakh है, so half of that would be basic salary. So 12% of basic, and let's say basic salary is 7,87,000, which is 1575 ka half.
Okay.
On that, if you do 12%, that would be 94,500 to be precise.
Okay.
Second thing, which is allowed under new regime, and we are only talking about the new regime as of now, okay? NPS. If your employer has a NPS provision, you can invest up to 14% of your basic, Sharan, and that brings to 1,10,250 of deduction for NPS.
Okay.
That's your second big thing. The third thing, which has introduced in this Income Tax Act 2025, is food coupon allowance. You spend on your Swiggy, your Zomato, your Big Basket, all this you can claim if you have a food allowance from your office. That's a meal coupon, food allowance, that's what it called. And from this year, that amount is 1,05,600
In a year.
in a year.
I can spend up to 1,06,500 rupees on Swiggy Zomato and pay zero tax on it.
Perfect.
Wow. So if an employer gives me this option,
Mhm.
then I have to pay zero tax on all my late night Swiggy Zomato orders.
True.
Wow, this is interesting. This is the first time it's happening.
This is first time it's happening. Up till now, it was only 24,000 and only it was there in the old regime. But this year onwards, it's in the new regime.
Wow.
So we have told many employer to include this because this is something like you are getting for free and anyway you are spending on that. So
I should also include this. I have around 200 people. Most of them are Gen Zs. So they will
love it.
They will love it.
They will love it.
Yeah.
So that's 1,05,600, Sharan. Now, 75,000 standard deduction is anyway allowed. If you include all these things, your deduction and exemption is 3,85,000, which brings your salary to 11,89,000, which means it's less than 12 lakh. So you pay zero tax. Just three things, Sharan. Your standard deduction you anyway get. You don't need to do any efforts for that. You contribute 12% from your basic salary, which anyway you need to save for your retirement and all.
To Provident Fund.
NPS. Okay. And this is the killer, which is 1,05,600. And I think everyone gonna use that.
100%.
Everyone 15, 20 lakh of salary, right?
Yeah.
So if
I think they're all spending at least 20,000 rupees a month on Swiggy, Zomato. Even Blinkit, all of that is included.
This is
Blinkit's up to everything.
Right.
Oh, wow.
So this is the Pluxy card and your Sodexo card and all that we typically see. That's a food allowance, okay? That an employer can introduce. And by doing all this,
up to 15,75,000 rupees of income, I pay zero tax. This is crazy, yeah? I didn't know this. So now let's talk about the second category of people like you who also get rental income, right? Like you have a house, you get rent for it.
Right. So Sharan, let's talk about someone who is getting a rental income. And I assume that his or her only income is rental income.
Okay.
Just to keep it very simple. Okay. So said somebody's about 50, only having a rental income. Now, people understand that till 12 lakh, there is no tax. But if you have a rental income of 17 lakh, you pay zero tax. Not 12 lakh, I'm saying 17 lakh. Now this rental income, Sharan, can be from a house. It can be from commercial shop. It can be from any property you get. This is considered as income from house property.
Wow.
And now the tax laws around this is that you get a standard 30% deduction. So if your rental income is 17 lakh, uska 30%, which is 5,10,000, which means your effective income will come down 12 lakh. So that's 11,90,000, less than 12 lakh, you pay zero tax.
Interesting. So just to do some quick math here. So you said up to 17 lakhs of rental income. In India, the rental yield is around 2 to 3%.
Right.
Let's assume 2%. So 17 lakh multiplied by 50 is how much? 85. So it is 2% of 8.5 CR. So 8.5 CR ka 2% is 17 lakhs. Right? So up to 8.5 crore worth of property, if I have in residential property, I will pay zero tax on that rental income, whatever basis or whatever you just said. Now,
even if you have a commercial property, shop, all will fall under this, Sharan. Not only house property. Because all this for income tax is considered as income from house property and you get a 30% standard deduction.
Okay. Interesting. So now let's talk about people who take a house on loan and then give it on rent. Is there a difference over here?
It's a big difference. I think, Sharan, you always suggest that you take a loan and then buy a house or a shop.
I say don't buy a house only.
But at least shop.
If you want to do this, then...
Of course.
Yeah.
So let's understand somebody is getting into the house or doing it for, let's say, letting it out. Okay. It can be shop also. It can be commercial office space also. Okay. Not just house.
Okay.
Because typically the rental yield is higher in the commercial premises, right?
Yes.
So let's say somebody is getting a commercial premises on a loan.
Okay.
Okay. And let's say the total income from that property is 25 lakh rupees.
Okay.
He or she can pay zero tax.
Wow. 2 lakhs a month hitting my bank account and I pay zero tax.
Zero tax. Legal.
How? Give me this example.
Sure. So at 25 lakh rupees, let's say somebody is getting a rent. First of all, what they will get is a 30% standard deduction, which now we are knowing, which is 7.5 lakh, Sharan, which brings your total net rent to 17.50. 17 lakh 50,000. Now, on this property, you are taking loan worth rupees 1 crore, 2 crore.
Yeah.
Okay. That interest you are paying is 5 lakh 50,000 in this example.
Okay.
Which means 17 lakh 50 minus 5 lakh 50, which brings your rental income after paying for interest to 12 lakh. And again, till 12 lakh, no tax. So Sharan, it can be so powerful and it's always recommended, even if you don't need it, take it on a loan. And Sharan, and many people are not aware, this is allowed under new regime. When I said that you can claim 5 lakh or 50,000, many people would comment on this podcast, hey, maximum 2 lakh rupees you can claim. I am talking about when you let out the property, you can claim any amount as an interest under the new regime as well.
Wow.
So this many people are not aware. So I can practically make Sharan my rent as zero also. So in this case, I'm just giving an example of 5 lakh 50,000. The loan interest can be 6 lakh, 7 lakh, 8 lakh, anything up to the rent you are getting. And you are paying interest on that. Also under new regime and old regime both, you will pay zero tax. Because the 2 lakh that normal people get confused with is if I'm buying property for staying in for my self-consumption.
Only if it is self-consumption, there is a limit of 2 lakhs.
And that's allowed only under old regime. But under new regime and old regime both, if I'm letting out property, I can claim any amount of interest as deduction.
Wow. So, okay, now I understood. So, even if the interest I'm paying the bank is 7-8 lakhs, I can use that entire amount for tax deduction.
100%.
Wow. And can that be net off, like you're right now you're netting it off against rent?
Right.
Can I net it off against my salary?
No, Sharan.
That is not allowed.
On your
Against my mutual fund returns?
No.
That is
Only
not allowed.
only against this you have to set it off.
Only within that.
Within that which I'm getting a rent on. As simple as that.
Nirmala ma'am is smart. Very smart. Have you ever wondered how much money you need to retire? Based on your monthly expenses and your investment growth rate, do you know what is your retirement age? This question bothered me for the last 10 years. So I thought, why don't I just build an app around this? So at the 1% Club, we are now launching our FinTech app powered by AI. This is the first time AI is being fed on your own personal financial information and giving you advice like a professional money manager. Head over to the 1% Club app right now, install it, track your FIRE number, and invest money like a professional money manager. It's completely free of cost, so try it right now. Now let's talk about the next one, which is professional income. There's a lot of freelancers out there who don't have a job, but they earn money through having clients by providing them services.
Right, Sharan.
What is that maximum income up till which they pay zero tax?
So let's say some professional, which is mentioned under income tax. And by the way, from this year, Sharan, that Income Tax Act, the new section is section 58.
Okay.
Up till now, it was 44 ADA. So if you are a professional qualified under that, which is accounting professional, legal professional, actor, your producers, cameraman, all that are covered. Influencers, right. All those are covered. And up to 24 lakh rupees if you have income from this qualified professions, okay, you pay zero tax. Because this section says that 50% of your total revenue you can qualify as an expense. So that's 24 lakh.
Without showing proof.
Without showing proof, and there is a gray area. So for example, this section is for the ease of compliance, ease of doing business, and for your convenience. So at least मुझे पता है कि when I'm providing services, I'm spending some amount on, let's say, buying a laptop, buying some softwares, like cloud subscription and all that thing, right? I have some intern also. So mota-moti, my expenses is, let's say, in the range of 40-50%. Then I don't need to maintain a books of accounts and all that thing. And my income is up to 75 lakh. Then I can claim this, but it should be a reasonable enough because there can be a scrutiny.
In my AIS.
Yes. And in your AIS, how this is happening? Because let's say somebody is having a 50 lakh rupees of income, Sharan. And now he's showing that, okay, 25 lakh rupees is an expense and 25 lakh rupees is income. And he's happily paying taxes and he's happy. Okay.
Because he didn't pay tax on the other 25 lakhs.
Right. But now he's investing this amount or either swiping credit card. It shows that it's not actually spent on a business. Then how all this money you are having with you. Okay. So the clear-cut thing is that income tax can come behind you. So if you have a genuine expense in this range, then only claim it. Don't blindly claim under this 50% standard deduction. So
meaning as a freelancer, if I'm making 50 lakhs.
Right.
And my actual expense is, let's say, 10 lakhs.
Right.
And that remaining 40 lakhs I invest in a mutual fund. And then while filing income tax, I'm saying that 25 lakhs is my expense, so I won't pay tax on it.
Right.
That is where I'll get caught.
Perfect. So that one should be remembering that it's not something that you can evade your taxes. You have to plan it.
Or if my expense is 25 lakhs, but out of that 25 lakhs, 10 lakhs is spent in Europe, then also they'll catch me.
Of course, they will catch you because your AIS also shows that how much you spend in a foreign and how much when you're traveling abroad. Yes.
So watching the Monaco Grand Prix is not business meetings. It's not counted.
Unless you can prove that you get business out of that.
All right. Need to figure that out. All right. The last one is people who are only making money through their stock market returns or mutual fund returns, which is capital gains income.
So if somebody has only income from capital gain of shares and equity mutual funds, and that is also a long term.
Yeah.
Typically, people understand that up to 1,25,000 you don't pay tax, and after that you have to pay 12.5% as a tax. But let's assume you don't have any other income. Okay, then up to 5,25,000 long-term capital gain, you will not pay any tax.
Oh, really?
And Sharan, when I say 5,25,000 of long-term capital gain, you are actually withdrawing more than 12-15 lakh, because when you withdraw out of your mutual funds or let's say shares, there would be a one portion which you have invested. So 5,25,000 is not a smaller amount. So somebody is withdrawing 15 lakh from the mutual funds every year, for example, or a shares portfolio. In that, up to 5,25,000 of long-term capital gain, there would be no tax, because 1,25,000 is anyway exempt and 4 lakh is your slab rate.
Achha.
And now if I have a family member, which is 4 family member, you understand that,
Yeah.
to 60 lakh rupees, you can claim that, because 15 lakh each, I'm just assuming that at 15 lakh, your gain is less than 5,25,000. And if you have 4 family members, let's say somebody is retired or somebody is above 50, not having any other income, this can be even this bigger.
Which means that, let's say I've made like 10 crores of savings and then I'm chilling in Goa, but I have a wife and I have 2 kids. Now I have to start withdrawing some money. You're saying, even if I'm withdrawing 50 to 60 lakhs, I am paying 0 tax on it because of this hack that you just told me.
Right, Sharan, very much possible.
Wow. Which means a lot of people, say that, okay, I've hit my retirement goal, but now I have to start paying taxes. But actually, even if you're spending 50, 60 lakhs, you're paying 0 taxes.
Of course, if you have planned well.
I like it. Now let's come to this year. Now when I'm filing my taxes, we are in 2026 now. So compared to last year, can you tell me all the things which have changed?
Sure, Sharan. So when you are filing taxes this year, which is on 31st July and 31st August.
Oh, we are filing in like 15 days. Oh my God.
So we are bang on time.
So you have to file it now. You have to pay.
Right. So most of these taxes would have been paid by your TDS and all that thing. But of course, there would be some tax which you have not paid. So you pay while you are filing. So ITR 1 and 2 from this year would be filed on 31st July. And ITR 3 and 4 would be on 31st August. So people,
what is 1 and 2? What is 3 and 4?
Yeah. So your ITR 1 is for a people with plain vanilla, simple salary income, less than 50 lakh rupees, not much of house property and all that thing.
Yeah.
Your capital gain from equity is less than 1,25,000. That's a simple ITR 1. Your ITR 2, which most people will fall into, which is if your salary of more than 50 lakhs, you have invested into foreign stocks, you have a crypto income, your capital gain is more than 1,25,000, or you have a short-term capital gain, you are an NRI, you are a director in company, all this, Sharan, will fall into ITR 2.
Okay.
So all those has to file before 31st of July.
Okay.
Okay. If they don't file on a time, there would be a 5,000 rupees of penalty.
Per month, I think.
No, it's 5,000 flat penalty, but they have to file before 31st December 26. Okay, that's called a bill letter return. But the penalty is not the biggest issue. Issue here is that if they have some loss, they cannot carry forward. If they want to switch to old regime, they cannot do. So it's more than penalty. You will be
Flexibility goes away.
Yeah, flexibility goes away. And now ITR 3 is typically your business and professions and all that thing. But along with your salary, if you are dealing into F&O, if you are doing a frequent trading, swing trading, all this would be considered as your business income.
Okay.
So all these people will file also ITR 3, which is 31st of August.
Okay.
And your presumptive taxation, as we just discussed, that professionals who are opting for 50% of the income as an expense, called presumptive taxation, will fall into ITR 4. So there is ITR 1, 2, 3, 4. Now the main thing is that when you are filing return for this year, you would be filing as per Income Tax Act 1961. Because, Sharan, you file return for the period which just got over, which is 1st April 25 to 31st March 26. And at that time, it was Income Tax Act 1961. So when I'm filing return, this time, right now, it would be as per 1961. But when I'm planning and what all we are discussing is as per Income Tax Act 2025, which is applicable from 1st April 26
So the year that is ongoing.
ongoing. And all this planning aspect which we are discussing, because I'm feeling pain that I'm paying too much of taxes. So
Yeah.
this is the time you start planning. So from this year onwards, you can pay less taxes. So Sharan, Income Tax Act 2025 is like old wine in a new bottle.
Okay.
Nothing much has changed, but it's simplified. The bottle is a bit more beautiful and transparent. That's what at least income tax says. So I'll just brief you what all has changed. Okay. Until now, only 4 cities were considered as a metro cities, which were Mumbai, Kolkata, Delhi, and Chennai. But from April 26, the new 4 city added, which is Bangalore, Pune, Ahmedabad, and Hyderabad. And if you are staying in this city now, there would be a better taxation in terms of HRA claiming. Up till now, I can only claim 40% of basic. There are formula to claim in HRA, Sharan. Okay. How much HRA you are receiving? 40% of basic if you are staying in a non-metro cities. But if you now stay in this 8 metro cities as per income tax, you can claim 50% of your basic as an HRA. And the third option is that rent paid minus 10% of basic. So mota moti, if you are staying in this 8 metro cities, and specifically for this newly added cities, the math can change how you claim your income tax. We will show that an example, but before that, children education allowance. If I have a school going child or a child, okay, I can claim 3,000 per month. This is not something new, Sharan, but up till now, only 100 rupees per month was allowed. So nobody was even noticing this.
This is for school tuition.
No, this is called if I have a child who is going in a school, okay, then I can claim 3,000 per month, which is 36,000 rupees. What I need is flexi pay benefit. So if you have some people who also have a children in your organization, you can include this children education allowance. This will be part of your CTC only, Sharan. Okay. But because I'm opting for this flexi benefit, I can claim an exemption for this. So which is 36,000 per children. So if you have 2 children, which is 72,000 rupees.
This
it's
is
that
for
big.
Only people in these 8 cities or anywhere in India?
This is anywhere in India. Thanks for asking. The only HRA is for 8 cities, which has become a bit better, specifically for the 4 new city which has just got added. Second allowance. Many people stayed in hostel. I also was staying in a hostel when I came to Mumbai, right? So the allowance for hostel has increased from 300 to 9,000 per month.
Okay.
So now if you have a child who was going school and also staying in hostel, you can claim both or any one of that. But okay, your HRA, your children education allowance and hostel allowance is only for old regime. But the biggest thing which we have discussed in the new regime and old regime both is your meal coupon, 1,05,600. So these are the 4 biggest changes when it comes to a salary. Now, somebody will feel that, okay, it's not much appealing to me at this level, but let me give you an example, Sharan. Let's say somebody is having a CTC of 30 lakh rupees. Up till now, he has opted for old regime. He is claiming 50,000 standard deduction. HRA is claiming 6 lakh. He's staying in a Bangalore. Okay. 2,400 is children education allowance, meal coupon 26,400. Up till now, which is 31st March 26th. Okay. And LTA 50,000. Your ELSS, PPF, ATC, which is, we call it 1,50,000. Health insurance 75,000. Saving bank interest. Many people are not aware. In old regime, whatever saving bank interest you can get, that also allowed as a deduction up to 10,000. So 10,000 is claiming that. So Sharan, after claiming all these things, which is the total deduction of total income from 30 lakhs falls to 20 lakh 36,000. And the tax payable on this is 4 lakh 40,300. This is if somebody's, I'm saying that salary remains same. What has changed between the last year and this year because of Income Tax Act 2025?
Okay.
Now, same person, seeing his salary slip now, how the math will look like. 30 lakh rupees CTC. Your standard deduction remains same as it is, no change in that. But your HRA, even if you are paying the same rent, because of this 50% of basic math, Sharan, that goes to 7 lakh 50,000 from 6 lakh earlier.
Oh, wow.
That is a big change. Many people are not doing this math and they are not cross-checking that in this year, old regime would be beneficial or not. Even the small change is increasing HRA by 1,50,000.
Wow. This is for old regime, right?
This is for old regime only.
Yeah.
Okay. Now, children education allowance, as I told you, from 2,400 to 72,000. Meal coupon, Big jump, 26,400 से 1,05,600.
Wow.
Now, your LTR remains same, your ATC remains same, your health insurance remains same, which is 75,000, and saving interest rate. Because of the three big change, which is HRA, Children Education Allowance, and meal coupon. Okay, your total income from 30 lakh, which was last year 20 lakh 36,000, this year it would be 17 lakh 37,000.
Because of the higher deductions.
Perfect. Because of these three changes which I told you, right?
Okay.
The tax payable is 3 lakh 47,000, which was earlier 4 lakh 40,000. That's a tax saving of 93,300.
Wow.
This is what has changed in Income Tax Act 2025 if somebody can do a smart planning, Sharan.
But they have to know to do all of these things.
Of course. They should do that. And that's why we have shown this example.
So
and
this is all of these things that you spoke about is for the following year that's coming up.
This, right? Which year we are right now in, because we have to plan taxes during the year.
Correct.
If I come after 31st March 27, I cannot save tax. If you are filing right now, you cannot do much about saving taxes.
Correct.
Because that's a post-mortem.
Yes. So what you're talking about just now is something that I can do for the next year. And this is because of the changes in the Income Tax Act.
Perfect, Sharan.
Now let's talk about how you can save taxes while investing.
Sure.
Right? And when it comes to investing, there is this rule that you have to follow that depending on when you need the money for,
Right.
you should invest in the right products. Right? So let us say I want to save for going to Bali next year.
Okay.
Can you tell me how I should invest my money and pay the least amount of taxes when I actually withdraw that money to go to Bali?
Awesome, Sharan. So you're talking about your short-term goal, which you want to go Bali next year.
Yes.
Okay. Let's understand that you want to go exactly after 12 months for ease of convenience. Okay. Now, people have two options. Either they have FD or a debt fund. But the interesting option for you, because you are in a higher tax bracket, is arbitrage fund.
Yeah.
And it is, I am going to explain with an example how much it would be beneficial.
Okay.
Okay. Let's say you are investing 10 lakh rupees in arbitrage fund versus you are investing 10 lakh rupees in FD. Let's show the math of FD or a debt fund. Okay, you invested 10 lakh, approx return is 7%. So after 1 year, you get 10 lakh 70,000. But 70,000 is your interest or a profit from your debt fund. Okay. On that, Sharan, thanks to the 30% tax you are in. Okay. Even you are paying more than that. But let's assume 30% tax. 21,840 you have to give to the government.
Correct.
Okay. So your pocket will have that much less amount, and not 70,000. This is a simple math.
Yeah.
Now, if you are investing in an arbitrage fund, more or less you get the same kind of a return. Okay, arbitrage fund is nothing. If you are investing in let's say fund manager, when you invest in this mutual fund company, fund manager invest into stocks and they hedge it or do arbitrage between the cash market and the future market. Okay,
Yes.
just to simplify that. Now, you have invested 10 lakh rupees into that. After a year, you have let's say 10 lakh 70,000 rupees. Okay.
Yeah.
Now, this 70,000, Sharan, because you are redeeming after 1 year, which is after 12 months, would be considered as a long-term capital gain as per equity. And because of that, you will not pay any tax because up to 1,25,000, there is zero tax. So all the 70,000 you can keep in your pocket, and maybe that 21,840 will sort out for 1 or 2 days of your nightlife in the Bali.
I like it. So basically, it's now possible to invest for your vacations and pay zero tax.
True.
Right? And most people are just keeping that money in an FD.
Right.
And paying 30% tax if they are in a very high income bracket. And most people are not aware of this option.
True.
Now let's talk about something that I want in the next 3 or 4 years.
Okay.
Let's say, for example, I'm saving money for my wedding and
Okay.
I added 50 lakh rupees. How do I save for my wedding where I'm going to spend 50 lakhs and pay very little taxes? Because I want all the money for my party.
Wow.
Yeah.
Okay, Sharan. So typically when you are investing money for, let's say 3 to 5 years, Sharan, you have a few options in terms of debt, which is your debt fund, FD, or let's say bond. And let's assume, again, I know you're going to spend a lot on your wedding, I guess.
Just 50 lakhs.
Okay. But let me give an example very simply. 10 lakh rupees. Okay.
Oh, fine.
Okay. 10 lakh rupees.
I'll have to ask, but okay. Okay, got it. Fine.
So right now, let's start with 10 lakh rupees. Okay.
Okay.
So because it's easier to calculate. That's it.
Okay.
So 10 lakh rupees, if you are investing in a FD, bond, or let's say debt fund, roughly you can get, let's say 8% return per annum. So you will have 14 lakh 70,000 rupees after 5 years.
Okay.
But Sharan, you have to pay tax on all this as per your slab rate. I'm assuming again 30% tax. which means you will pay 1,46,640 rupees into taxes out of 4,70,000.
Wow.
Out of 470, you will pay 146,640 into taxes.
Hmm.
Now, let's say you are investing into equity savings kind of a mutual fund, multi-asset mutual fund, or dynamic asset allocation fund. These are typically mutual fund, has equity, debt, and some portion of arbitrage and all that thing. This is a very popular mutual fund category, but many people are not looking from the tax perspective. Because Sharan, when I'm investing, I need to take care of two aspects. The first is risk-adjusted return, and the second is tax-adjusted return. And most people fail at both. Okay. Now, let's say I'm investing 10 lakh rupees, Sharan. The first benefit here, you can expect around 10%, 9 to 10% return on all this product when you're investing for 3 to 5 years. So, Sharan, after 5 years, the amount you will have is 6,10,000 rupees. Okay. In FD, I had 1470. Here I have 1610. That's the first benefit.
Sweet. 6,10,000 is the profit.
Profit, of course.
After
So
5
that's
years.
why 16,10,000 I'll withdraw.
Yeah.
And 6,10,000 is the profit. On that, I have to pay 12.5%. But on first 1,25,000, I'll pay zero tax because every year you will not pay any tax on 1,25,000 of long-term capital gain.
Correct.
Now, the tax you will pay here, Sharan, on 6,10,000 is 63,050 rupees to be precise versus 1,46,640.
Wow.
So you have roughly 90,000, 80,000 higher than the FD.
Wow.
Now, something nobody is thinking at your level of income, for example, or anyone who is having income of 45 lakh or a 90 lakh around. Why I'm specifically talking about this kind of a population? Because your income can go above 50 lakh rupees or 1 crore. Now you'll have to pay surcharge on all the income that most people are not considering because you cannot control. Even if you are, let's say, investing in a cumulative FD, you have to pay tax every year because that interest would be credited in your bank FD. Okay. And because of that, you cannot control when you want to withdraw. And your income is near to this surcharge level. So we have one client. Income is 1.8 crore. She got roughly 20 lakh rupees as an interest from FD bond and all that thing. Because of that, because of her income crossed 2 crore, now on all the income, she has to pay surcharge. That
Wow.
can be as high as 25% over and above your tax.
Wow. So,
So-
if you make more than 2 crore, you have to pay another surcharge on your
Of
tax.
course. If you cross 50 lakh, there is a surcharge of 10%. If you make more than 1 crore, there is a surcharge of 15%. Once your total income crossing 2 crore, there is a 25% surcharge.
So my 30% income tax will become how much?
39%, Sharan. So
I
people
pay
say
39% tax.
you are into 39% tax bracket. If you are in the new regime, if you are in the old regime, you are paying 43% tax, Mr. Sharan.
Why?
Because the surcharge, there is a surcharge above 5 crore at 37% in old regime. So if you are in old regime, your surcharge can be as, the total tax is as high as 43%, but in new regime, it can be as high as 39% and not 30% or 33%.
This
So
is
that's the
this is
tax.
this is why I take zero salary. This is the learning. So now tell me about long-term investing, right? Like when I'm saving for my retirement, when I'm
Okay.
saving for my kids' future,
Okay.
and pay zero taxes or minimize my taxes while I'm investing for that long-term goal.
Sharan, so let's say when you are investing for a long term, there can be many options. But let's talk about the professionally managed options. It can be a mutual fund.
Yeah.
It can be a PMS also.
Yeah.
Mota moti, it looks same because there is a fund manager in the mutual fund and there is a fund manager in the PMS also.
Yes.
But let me show an example how the tax would be there and how one should select the any product by keeping at least taxation in mind. Okay. So let's say, Sharan, you are investing 50 lakh at one go because PMS takes minimum 50 lakh rupees.
Yeah.
If you invest 50 lakh rupees, every year your fund manager in the PMS will do certain buying and selling. Okay. In your demat account, your PMS manager will do certain buying and selling. And let's say he has generated 5 lakh rupees of profit. You are happy.
Yeah.
Okay. But government is also happy because you will pay 20% tax on that short-term capital gain. So on 5 lakh rupees, you will pay 1 lakh as a tax. Now the bigger problem, you have not withdrawn anything from the PMS, Sharan. Your 50 lakh rupees of PMS has become 55 lakh rupees because there is certain profit booked by your fund manager. You are happy, you are getting 5 lakh as a profit. But though you have not withdrawn anything, you will pay 1 lakh as a tax when you file return.
Right.
That is first thing. Okay. Now let's see a second year. Okay. Second year from 50 lakh, 55 lakh. Again, your fund manager has generated 5.5 lakh rupees of profit. So your total portfolio from 50 lakh started. Now it is 60.5 lakh. Again on 5.5 lakh, Sharan, you will pay 20% as a short-term capital gain, which is 1.1 lakh. Now, 10.5 lakh rupees of gain in 2 years. You are happy, as I told you, but you have paid 2,10,000 in taxes in 2 years, which is net in hand is 8,40,000. Am I right?
Yeah.
Now, how the tax is levied, you need to understand that. So when I'm investing in PMS, because fund manager is buying and selling shares in my demat, okay, I have to pay short-term or a long-term capital gain accordingly. Now, let's say somebody has invested and you have invested instead of PMS into the mutual fund.
Yeah.
You have invested 50 lakh. Same kind of a performance in your mutual fund. 50 lakh rupees of mutual fund after 1 year is 55 lakh rupees. You will not pay any tax because you are not withdrawing. Your NAV has increased. You will not pay any tax.
Yeah.
Okay. After 2 years, you want to withdraw this. And let's say from 50 lakh, your mutual fund portfolio has also become 60.5 lakh rupees, which is a gain of 10.5 lakh rupees in 2 years. Now, when you go and withdraw this 60.5 lakh rupees, the tax you will pay is 1,15,625 at 12.5%. Of course, you get that 1,25,000 benefit. And after considering that, to simplify, this is 1,15,625 tax. So in both the product, the gross return is same, which is 10.5 lakh. But effectively, after tax, in mutual fund, you have 9,34,375 to be precise in your pocket, which is 94,000 of extra return just by planning smartly. This is the disadvantage in the PMS. Again, I'm not deselling PMS, but I'm just making it sure that if you are investing in PMS, your return should be at least higher by 2-3% than the mutual fund. Then it makes sense because the dividend you receive, Sharan, in PMS, that also taxable in your hand as highest rate, which is in your case 39%. So this is what I'm trying to tell you. In mutual fund also I get a dividend, but that is reinvested because
so it won't have to pay tax.
Of course. So the tax deferment people don't understand. And this is what exactly we are trying to make a point that how you should look at post-tax return.
So basically, if you are investing in a PMS, you should at least get 2 to 3% higher returns than your mutual fund returns for it to
Then you break even.
That's when you break even.
True.
So if you're not getting at least 2 to 3% alpha, then that PMS fund manager is not doing a good job for you compared to a mutual fund manager.
Agree.
Right? And if you're going for a PMS fund manager, you're going for a higher risk strategy. So you better get higher returns.
Better return also.
Right?
True.
If you're getting same returns, then actually you've lost money compared to mutual fund
Perfect,
investing.
True.
Makes sense. Now let's talk about harvesting, right? Like a lot of people just invest and forget, right? When it comes to mutual funds or stocks, most people have that josh whenever the market is doing well and they will invest, but then they don't open for months.
True.
And then they miss out on tax saving opportunities. So can you tell us what are the tax saving opportunities that people are missing out on today when investing in mutual funds and stocks?
Right, Sharan. Sharan, from 2004 to 2018, there was no long-term capital gain in India. First time it introduced again in 2018.
Yeah.
Okay. Now, though it's introduced, and of course we have to pay tax, but if you plan well, okay, you can pay up to 0 tax on your long-term capital gain.
Oh, wow.
Up to a certain amount. And I'll give you an example and then we'll explain.
Sure.
Let's say there are two friends, Ajay and Dhaval. Ajay has invested 5 lakh rupees into mutual fund, became 10 lakh after 4 years. Ajay was not knowing about any kind of a tax planning. He has paid 46,875 in taxes.
5 years later when he sold.
Yeah. 4 years later when he sold, 5 lakh rupees of mutual fund invested or stocks invested, a portfolio mix of, let's say, mutual fund and stocks. 5 lakh invested, done good job after 4 years for some goal. He has withdrawn that. Paid 46,875 tax.
Okay.
Dhaval has done the proper planning and paid 0 tax on the same kind of mutual fund portfolio where Dhaval has invested 5 lakh, grown to 10 lakh after 4 years and paid 0 tax. So he here saved 46,875 in taxes. Let me show you how. Sharan, when I'm investing into mutual fund or stocks, it's not going to be in the straight line, right? So it's not that I will open after 4 years, but like you told, many people are doing that. Nothing wrong. I'm there for the long term, but you need to review your portfolio. You need to restructure your portfolio and also need to do a tax planning. So let's say what Dhaval has done. He has invested 5 lakh. After a year, exactly after 12 months, that has become 6,25,000. He sold the same mutual fund and bought back the same mutual fund, or after some changes, he bought that again. So he has booked 1,25,000 of profit. And as we are discussing, again, on 1,25,000 per pen, you pay zero tax. So he has paid zero tax. Fast forward second years. He bought 6,25,000, became 7.5 lakh after second years. So 7.5 lakh rupees is the value of mutual fund he sold. But the purchase price, Sharan, is 6,25,000 because I done this transaction once already. Now, the capital gain is 1,25,000. Second year, I did the same, paid zero tax. Third year.
So when you do this, doesn't it affect the compounding of your investment? Because some people argue that, the NAV keeps on increasing at which you purchased.
Right.
So what is your, answer to that?
That's the common question, and thanks for asking this, Sharan, because whenever I'm explaining this concept, people think that, hey, this is for a long term. I should not be doing this frequent churning.
Yeah.
So the first disclaimer here is that the tax should be a byproduct. Your compounding will not get impacted because I'm not timing for market.
Yeah.
I'm not saying that, hey, Sharan, now the value is 6,25,000. Let's wait for a few months because there is a war going on. I'll buy it lower. No, there you are doing a mistake because now you are timing the market. No, we are not doing that. I sold 6,25,000. I bought it again in 2 days. Okay, that's the one thing. So now, because I'm not staying out of the market for a long, actually I'm not impacting.
Like within the next day only you have to buy.
Yeah, you can do that. And many people are not aware, which we do for our client. You don't need to even sell it. In mutual fund, you can switch it.
Yeah.
So from flexi cap, let's say I found that small cap is better value. So from X flexi cap to I'll go to Y small cap. That is considered a sell and purchase. But I'll plan it such a way, I'll realign the portfolio.
But within the same fund house.
Yeah, within the same fund house, you have to do that switch transaction. Otherwise, of course, as I told you, you can always withdraw and put it back and something like that. This is also possible in shares if you feel that, because here, Sharan, after every 1 or 2 years, there would be few mutual fund, few shares either not performing or you want to rebalance it in some or other way. So you have to do it as a primary goal and your tax saving is a secondary goal.
Yeah.
But now, let's say fast forward to third year, 8,75,000 he sold and the purchase price was 7.5 lakh because till now we have done this transaction for 2 years. So 1,25,000 not tax. And last year, this 8.75 lakh rupees of mutual fund, let's say increased by 1,25,000 after the end of 4 years, which is 10 lakh rupees. So 10 lakh is a selling price. And because I have done these transactions every year, my purchase price has got escalated. And that is 8,75,000 and I have paid zero tax. So
that increasing NAV is a good thing.
Good thing for you.
For you to save your taxes because then at the final day, your profits will still look like it's less than 1.25 lakhs.
Perfect.
But actually it has been much higher. But because of this buying and selling, NAVs have gone up artificially.
Right.
And at the end of the redemption day, you can say that, hey, my tax is zero.
Right,
that's the game.
That's the harvesting, and Sharan. So every year, if you are doing this activity, you are saving 15,625 in taxes. But again, you are not investing just from your account. From your wife, your mom, your dad, or your siblings. If you do it from 4 accounts, that's 62,000 of tax saved every year. And many people are living this.
Most people are not doing this because, like you said, this can be done during the year, not at the end of the year. So whatever you said, I can't do it for this last year's filing.
It's gone.
I have to do it for 2027 filing. And if I want to save the 62,000 rupees, start right now.
Right now. After the podcast.
Now let's talk about loss harvesting, right? Because a lot of people are seeing red in their portfolio.
True.
Trump said something. Every week he's saying something. Market is going up, down, down, up. Depending on where you've invested, you might be in a lot of losses right now.
True.
In fact, the Indian markets have gone nowhere in the last 2 years.
Right.
That is the average.
True.
But most people are sitting on big negative returns also. Is there a way to save taxes from this? Is there a silver lining to this Trump madness?
There is, Sharan. Because if you again plan well, your loss can help you save taxes. You rightly mentioned that most people's, and let's say my direct equity portfolio or my mutual fund portfolio in short term is also negative.
Yeah.
Okay. But now, Let me give an example of a client. This is a practical example. Because there is a profit in gold.
Okay.
He has bought gold before few years. And now the gold allocation in his portfolio has increased.
Yeah.
So now, he sold gold worth rupees 10 lakh rupees. और उसके अंदर 5 लाख का profit है.
Okay.
Now he want to save tax on this 5 lakh rupees.
Gold, how much is the taxation on profits?
12.5% after 24 months.
Okay.
So if you bought a gold, fund of fund, or a physical gold, and you're keeping it for more than 24 months, you have to pay 12.5% tax, and there is no 1,25,000 benefit. So on 5 lakh
Before
rupees,
24 months if I sell?
as per your slab rate.
Oh, gold if I sell before 24 months?
As per your slab rate.
Oh,
So
wow.
for you, again, it's 39%. Sure.
Mm.
So don't do that short-term trading in gold.
And I think gold and silver, that is what's happening right now.
Right.
And people are ending up paying in their
Huge tax.
income slab rate.
Slab rate. And that which many people are not aware, Sharan.
Mm.
But if they plan it well again here, let's say you have a gain in gold.
Okay.
You have to pay tax because you want to come out of gold. You think that portfolio में बहुत gold बढ़ गया है नितेश, थोड़ा इसको कम करते हैं, ठीक है?
Yeah.
So you sold out of 20-30 lakh का gold, 10 lakh का gold बेच दिया, and in that 5 lakh rupees is a profit.
Yeah.
10 lakh के gold में 5 lakh is a profit, which is 100% increase. Okay. Now, on this 5 lakh, you have to pay 12.5% tax. But there is a way to minimize the tax on this profit, or you can even make it zero. Because you just mentioned you have some shares, or in this case also in my client, he has some direct equity which were in loss. Now that loss can be short term or long term.
Mm.
And in his portfolio, there was a 4 lakh rupees of a loss. I told him, sell this shares and book the loss. Okay. He got bit, hey Nitesh, this is for long term.
Mm.
This Trump will go, this Strait of Hormuz will open and it will be green.
Yeah.
So that's good. You buy it back after 2 days.
Yeah.
So yeah, what will happen? I said magic will happen. If you are booking gold ka gain, which is 5 lakh, which you wanted to book, which you booked, but because of you are doing this loss harvesting, you booked this notional loss in equity to actual loss. So you sold that shares or a mutual fund and you shown loss in your account. So your 5 lakh profit of gold can be set off again 4 lakh loss in mutual fund or stocks. This is called cross asset adjustment, which again many people are not doing because they are not aware. So that client of mine has paid tax only on 1 lakh, Sharan, and not 5 lakh, because this 4 lakh got adjusted.
Mm.
That is the better way of doing loss harvesting. Even if you don't have any profit but you have loss, even if you are booking that,
Yeah.
okay, you can carry forward that loss for 8 years. So whenever in future you have a profit, you can set it off against that.
Oh, wow. So if I have not been able to use all the loss this year, I can use it for the next 8 years.
8 years.
Wow.
That's so powerful.
I think this is a very bad year in general. So if there is a lot of loss, I can save that loss as my future reduction strategy.
Perfection.
Hmm.
So
But the only way to save that loss is to book that loss
right.
through loss harvesting.
Perfect. And file return before 31st of July.
Because I won't be allowed.
Yeah, that was the thing we were discussing
Yes.
before few minutes, right?
Correct.
Because I miss out on the return filing due date. I cannot carry forward loss.
Hmm.
So many people, what they are doing, I have a loss, I don't want to file return.
Yeah.
That's a bad thing.
Now let's talk about, the current modern employees when they are joining a job. The term ESOPs have become very popular in salary negotiation. So almost every single person who is watching this podcast today is having some amount of ESOPs in their name. And we also hear stories about Grow becoming IPO and a lot of employees becoming crorepati's overnight. I think even Zepto IPO is coming and all the employees of Zepto are now seeing how much money they will make.
True.
But what is the reality of ESOPs from a taxation point of view?
So let me give you a practical example. Let's say somebody is joining your company, 1% club. You are offering them ESOP. Okay. Typically, this will vest over 3-4 years.
Correct.
Okay. That's called a vesting period. There is no taxation at the time of vesting because you are giving an option to buy that ESOP. But let's say now you are near the IPO. Okay. Now, all this vested option, somebody is exercising. Okay, why I'm using this term? Because that is the ESOP term. Okay, so this is when it is vested, there is no taxation. But when you are exercising ESOP, you have to pay tax as per your slab rate. Let me give an example. Okay, let's say fast forward let's say fast forward 3-4 years down the line when the 1% Club IPO is near. Okay. Somebody got an ESOP and now they are exercising this ESOP. Let's say the value of ESOP, fair market value of ESOP at that point of time is 500 rupees.
Okay.
Okay. And you are giving them just for 10 rupees because they are their employee. They are your employee. Okay. Now, they will have to pay tax on 490 rupees because 500 rupees is the price of fair market value of that 1% Club share and 10 rupees is they are paying. So, practically 490 is the benefit they are getting because they are employee. Okay. Now, they have to pay tax on this 490 rupees. This can be as high as 39% tax. So let's say somebody is getting 2 crore rupees of worth of ESOP.
Okay.
And they are exercising on 2 crore. Roughly they will pay 40% tax, 39% tax. Okay. And that also before even they exercise.
Before they even get the shares.
If I want that shares in my demat,
I have to pay the tax first.
39% tax.
But why is it like that? Why the government does
Right.
this?
Because Sharan, at that time when I'm exercising, okay, only at that point of the time it is considered that I am now owning that capital asset.
No, why can't I first get the shares first, then pay the tax?
Okay. So in that case, it is something like your salary. When you give a salary to your employee, you deduct the TDS first. This is the same. This is called salary. This is called a profit in lieu of salary. So you are giving instant of a salary or along with a salary or as a benefit. So this is how the taxation works. So when you are exercising, you pay 40% tax. 39 to 40% depending upon your tax slab. And as I told you, because of surcharge, most people are becoming crorepati and paying 39% tax. Again, fast forward. You are ringing bell in NSC. Imagine that, Sharan. Okay. Now, IPO got listed at 1,000 rupees. Bumper gain. 500 worth of FMV listed at 1,000.
Okay.
Somebody exercised at 500 on 490 rupees, paid tax, and now selling at 1,000 rupees.
Again, they have to pay
They have to pay tax because now this is a capital gain. But the purchase price for them is 500 now, not 10 rupees. Okay. Because on 490, I've already paid the tax. So there are not double taxation. It's a 2 times I pay tax on 2 different incidents.
Got it.
First is as a salary and second as a capital gain. But now, Sharan, how you exercise and how you get out of that ESOP at both level, you can plan your taxes. How it is possible. Again, let me give you an example, okay? We have many clients who are in CrowdStrike, Amazon, NVIDIA and all that thing. These are already listed. So you exercise this share when the market price is lesser. Because of that, let's say if for example, this same shares of 1% Club, if I would have exercised at 300 and not at 500, I will pay tax on 300, Sharan, and not 500.
Achha.
And on your exercise, the tax slab is higher. I have to pay 39%. Right? So this is the first planning.
But the issue with that is I don't know when the company will go IPO also, no?
True. So again, this is for something where you have an option or company is already listed.
Okay.
That is
and the company is already listed.
Or listed. That's why I gave an example of NVIDIA, CrowdStrike, Amazon, because now people are getting ESPP, RSUs and all that thing. So the first planning happens when you exercise that can make or break. Why? Because Sharan, I have seen many prospects who comes to us. They are already falling in surcharge because they are exercising shares. So let's say your salary is 1 crore. You exercise only 50 lakh this year. You can also do in parts. So that's the first planning. Second planning. Then that's the biggest, and you can actually pay 0 tax instead of paying that capital gain of 15%, Sharan. Okay. Capital gain would not be 12.5%.
Okay.
Because you will have to pay surcharge here also. So the capital gain tax is 14.95%. Okay. This many people are not aware. Why? Because there is a maximum 15% surcharge applicable on your capital gain because your income is higher than 2 crore. Now, so if you don't want to pay that 15% tax, you buy the house. So let's say even if you gain of 5 crore rupees, okay, you can buy the house and you can pay 0 tax. That's section 54F. So that's why you're seeing that in Bangalore and all that thing.
Real estate boom is
happening. And because from Flipkart to now, many people are coming with this exit in the IPO. The first thing most of the people are doing is buying a house. Because up to 10 crore, you will not pay any tax. So this is when, like you rightly said, you buy a house because you save a huge amount in
taxes. You have
taxes.
no other option. You can save up to 40%
right.
tax.
Right. But Sharan, for that, somebody has to plan for next 5, 7, 8 years. And because if I already have more than one house, then I cannot do that. So if you want to take benefit of this section, Ideally, you should not have more than one house in your name.
So basically, you should not have any. You should have only one house.
One house.
Then
maximum.
you can do this again.
They can do again, right? So this is how it works.
Now let's talk about something which a lot of people keep asking me: how to use HUF to save taxes. Right? It's become very popular on social media. For the first time I made a reel on this was in 2021.
Wow.
Right? From then till now, everybody is still asking, HUF kya hai? How do I save taxes on HUF? Now, as somebody who's been doing this, I'm assuming for some of your clients.
Many of our clients, right?
Can you tell me how to exactly implement creating a HUF and what is the benefit of doing this to save additional taxes for me and my family?
Okay. So Sharan, two big things. Because you are going to get married, as you said, in near future.
Yeah.
Okay. The moment you are married, your HUF is in existence. If you are Hindu, Jain, Buddha or Sikh. Once you are married, your HUF is already there. You just need to go and register. And when I say register, you need to have a PAN card and a bank account and your HUF is in place.
Okay.
But a caveat. This HUF can only be used for a certain purpose. Because for HUF, to be an HUF and a separate assessee for income tax, you need one child also. So you have to wait for a few more years after you get married, Sharan.
So without having a kid, I cannot have an HUF.
Right. So many people don't know this. And I told you, you can have an HUF, Sharan, but only can be used when you get assets from your family. Let's say your father is transferring a house to you, or let's say your father is transferring their portfolio to you. That can be transferred in Sharan's HUF. Okay? Even if you don't have a child. But let's say you want to do a business out of your HUF. You want to invest on your own from your HUF. That does not have any legal identity as an HUF because you don't have a child. This 99% of the people are not aware. Second biggest myth around, because people has already created. Let's say they have a child or they don't have a child. What they do? Let's say Nitesh Buddhadev HUF. Nitesh Buddhadev and Nitesh Buddhadev HUF. I have a PAN card, I have registered. Now, what most people are doing? I put 10 lakh from me to HUF bank account and invest into mutual fund or FD. At the time of transferring, when I'm transferring to my HUF, there would be no tax to HUF. But once the HUF invest into stocks, mutual funds, bonds, anywhere, income, whatever it received from all this investment would be clubbed in my hand because I am a karta, or let's say my wife or my child cannot transfer any money to HUF because that's not the purpose of HUF. HUF can function as a business. Okay, so how to do the business? The next thing comes how I get the capital. You can get the capital from a loan or you receive some gift into HUF up to a certain amount, or the best way that my HUF gets property instead of my name into the HUF's name. I get family portfolio in the HUF name. Why? Because now I have a Nitesh Buddhadev, on that I have a business income, professional income, and Nitesh Buddhadev HUF where I have a real estate income, which I got from my family and all that thing. This is how one needs to take care of that. So HUF can be a good tax saving.
But basically, HUF is good for people who have a rich dad or mom. So that when they transfer the money to you, it can go to the HUF.
Right.
Because if you yourself put the money in that, then it is not considered for tax saving purposes.
True. Or you have to plan it in such a way that is fruitful. So there are many people who are doing business in the name of HUF. That is valid.
Like proper business.
Proper business.
But most people are creating HUF not to do business. They're doing it for doing, tax saving.
So that's tax evasion or tax avoidance, Sharan. They are not planning it well and they cannot use the HUF. But there are proper way to use the HUF if you plan it well. Even you are creating for yourself. But it takes a long-term planning.
Yeah.
That's how it works.
Perfect. All right, guys. So that brings us to the end of the tax planning strategy for 2026. For all those people who watched until here, you are already in the top 0.01% of tax experts in this country. So make sure to implement all of these things if you want to ensure that you save an additional amount of money in the next year's tax filing. As for this year's tax filing, you cannot do anything extra because it's already done. On that note, guys, I'll see you in the next one.
Before you go, guys, if this video gave you even one insight and made you feel differently about money, don't just keep it to yourself. Share it with your friends or family member who could use it too. And if it has sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make this conversation sharper and more useful for you. As long as you have me subscribed, and make sure that you walk away with one new thing every Wednesday and Saturday.